Hey everyone, welcome back to Corporate Decoder, the place where we peel back the layers of corporate jargon and financial reports to find the real story. And today we are diving into a report that suggests even in the world of private credit, things are not always as silent as they sound, like a quiet loan that might just start singing its earnings. Before we dive in, if you dig getting straight insights from these dense filings and want to understand what is really going on behind the scenes at big companies, make sure you are subscribed. We also have a fantastic Discord community linked in the description below where we break down these reports even further, so come join the conversation. Our focus today is on Golub Capital Private Credit Fund and their recent Form 8K filing. Now, an 8K is essentially a current report that companies use to announce major events that shareholders should know about. Think of it as the company's way of shouting important news from the rooftop. This particular report from the 23rd of October 2025 touches on a few key things, but the big headline here is about their distributions. Specifically, they're detailing the regular distributions for their Class I and Class S common shares. Let's break down what they've announced. For the Class I shares, Golub Capital Private Credit Fund declared a regular distribution of $0.1875 per S share. And get this, for these shares, the shareholder servicing and IOR distribution fee was zero. That means the entire $0.1875 landed directly in the shareholders' pockets, nicely contributing to their bottom line. Now, for the Class S shares, the situation is a little different. They also declared a regular distribution of $0.1875 per S share, which sounds the same, right? But there is a catch. The shareholder servicing and VOR distribution fee for Class S shareholders was $0.0178 per S share. This means that after the fees, the net distribution for Class S shareholders came in at $0.1697 per S share. So, while the gross distribution is identical, the net amount received by shareholders differs due to those fees. It is a good reminder to always look beyond the headline number and check what fees might be eating into your returns. These distributions are set to be paid out around the 26th of November, 2025, to shareholders on record by the end of October. Shareholders can either take this money as cash or, if they're part of the fund's distribution reinvestment plan, they can automatically reinvest it back into more Class I or Class S shares. Moving on to some broader portfolio insights as of the 30th of September 2025, this fund had its money spread across 414 portfolio companies with a total fair value of about $8, $555 million. That's a significant chunk of capital being deployed. When we look at how they categorize their investments, the picture is quite clear. A whopping 96% of their investments are in what they call first lien senior secured debt. What does that mean in simpler terms? Imagine you are lending money to a company. First lien senior secured means your loan is at the very front of the line to get paid back if that company runs into trouble. You are the first in line for any collateral or assets, making it a much safer bet compared to other types of debt. Another 1% is in junior debt, which is riskier, and 3% is in equity and other investments, which can have higher potential returns but also higher risks. So they are playing it pretty safe, heavily leaning towards the less risky end of the debt spectrum. And when it comes to interest rates, it is not surprising in today's market. Approximately 99% of the debt investments in the fund's portfolio, based on their value, are floating rate. This means the interest they earn will go up or down as interest rates change. Only about 1% of their debt investments had a fixed interest rate. Floating rate debt can be a double-edged sword. It means more income when rates are rising, but less when they are falling. Now, let's talk about where this money is actually invested across industries. The top sector for them by far is software, making up 20% of their portfolio. Following that, we see hotels, restaurants and leisure at 7%, and then a few sectors clustered around 6% each: diversified financial services, insurance, and healthcare providers and services. We also see healthcare technology at 5%, and then a few others like diversified consumer services, healthcare equipment and supplies, its services and specialty retail, all at 4%. This shows a diversified approach, but with a clear tilt towards technology and services, particularly in the healthcare and software domains. By the end of September, the fund's total net asset value, or NAV, was about $4.059 million. The fair value of their investments was $8.555 million, and they had roughly $4.774 million in debt outstanding. This gives them a debt to equity leverage ratio of 1.18 times as of the 30th of September 2025. This ratio tells us how much debt a company is using to finance its assets relative to its equity. A ratio of 1.18x suggests that for every dollar of equity, they have about $1.18 in debt. This is a moderate level of leverage, indicating they are using debt to amplify returns, but not excessively so. especially for a credit fund. Digging into the per share numbers, the net asset value for both Class I shares and Class S shares stood at $25.16 as of the 30th of September 2025. This consistency is important, showing that while fees might differ in their distribution, the underlying value of the shares is valued the same at that point in time. It is also notable that no Class D shares were outstanding during this period. Finally, let's touch on their ongoing public offering. Golub Capital Private Credit Fund is continuously offering up to $5.0 billion in common shares. As of their latest subscription date on the 1st of October 2025, they had issued Class S shares with a total consideration of over $197 million and Class I shares with a massive total consideration of over $3.3 billion. This indicates strong demand and significant capital being raised through this ongoing offering, especially for the Class I shares. So, what does all this tell us? First off, Golub Capital Private Credit Fund is heavily focused on securing its investments, with a clear preference for senior secured debt. This implies a strategy that prioritizes capital preservation while seeking steady income from interest payments. Their diversified industry exposure suggests they are not putting all their eggs in one basket, though there is a notable concentration in software and healthcare related sectors. The continuous public offering and the substantial capital raised indicate investor confidence and the fund's ability to attract significant investment. The difference in net distributions between Class I and Class S shares is a key point for investors to note. While the gross distribution might look the same, the net payout can be quite different due to fees. For Class I, it is a direct pass-through, essentially fee-free returns. Class S, however, has a fee nibbling at those distributions. This highlights a common dynamic in investment funds where different share classes come with different fee structures, impacting the final return to the investor. Looking at their leverage, the 1.18x debt equity ratio is generally considered manageable for a credit fund. It suggests they are employing leverage to boost returns, a standard practice in this industry, but are not taking on excessive risk in that department. The bulk of their debt investments being floating rate means their interest income will be sensitive to market rate changes, which could be a positive or negative depending on the overall interest rate environment. In conclusion, Golub Capital Private Credit Fund appears to be operating with a conservative investment strategy, emphasizing senior secured debt, while actively raising significant capital through its public offering. The key takeaway for investors is to understand the nuances of different share classes and their associated fee structures. As this directly impacts net returns, the fund shows solid execution in capital raising and a clear focus on stable income generation through senior debt. Alright, that is our breakdown of Golub Capital Private Credit Fund's latest filing. What is your take on these numbers and what they signal for the fund's future? Do the fee differences between share classes stand out to you? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and be sure to subscribe for more deep dives into the world of corporate finance. And don't forget to join our Discord community, linked in the description, to keep the conversation going. Thanks for watching, and we'll see you in the next Decode.